All right, let's get right to it. Today, we are breaking down the exact trading blueprint that a verified 8-figure trader used to pull in over $10 million. We're going to take years of complicated strategy and boil it all down into a simple, powerful framework you can actually understand in the next few minutes.
And honestly, that's the whole point here. We're cutting through all the noise, all the confusion around inner circle trader concepts to give you the core mechanics, the stuff that really moves the market, presented in a way that's clear and, most importantly, repeatable. Okay, so let's dive into this blueprint. At its very heart, this is all about shifting your perspective. It's about moving away from thinking like a retail trader who's always getting caught in the chop and starting to operate like a professional who has a clear mechanical plan. This slide really says it all. It shows this fundamental shift in how you look at a chart. You know, retail traders often just see chaos. They get lost in a sea of indicators and random patterns. But the professional framework, it's all about structure. It's about following a clear directional bias with a clean, repeatable process. And that's exactly the framework we're going to build right now. So how do we even start to build this thing? Well, it all begins with a top-down analysis. Before we even think about clicking a button, we need to understand the big picture, the overall market trend. It's like a general surveying the entire battlefield from a hilltop before sending in the troops.
And here's the absolute key. You always need at least 2 time frames. This is non-negotiable. You use one high time frame to figure out your overall directional bias. Are we generally going up or down? And then you have a second, lower time frame where you're going to hunt for your precise entry.
This chart here gives you a perfect roadmap for that relationship. If your main analysis is on the weekly chart, you're looking for your entry on the daily. If you're scoping out the 4-hour, your trigger is going to be on the 15-minute. See how it works? The high time frame tells you the story, the low time frame gives you the entry point.
So how do we know that trend is actually continuing? This is how. We look for something called a market structure break, or MSB. It's simple, really. It just means the price is pushed past a previous high or low, and, this is the important part, a candle actually closes beyond it. That close is our clear signal that our directional bias is still correct and the trend is very much alive.
And within that trend, we want to be smart. We want to operate logically. Once a new high is made, for instance, we can split that entire price range right in half. The top part is what we call premium. That's the expensive zone, where you'd look to sell. The bottom half is the discount zone, the cheap area where you want to be a buyer. The goal couldn't be simpler. Buy low, sell high.
Okay, so we've got our direction. We know we want to buy things when they're at a discount. But where exactly do we look to get in? This is where we need to identify our high probability point of interest, or POI. And our most important POI is the order block. It's just a fancy name for the last little pocket of selling right before that big wave of buying that broke the previous high. This zone is absolutely critical because it shows us where the big institutions, the so-called smart money, likely stepped into the market. And that makes it the most logical place for the price to come back to, find support, and then continue the trend.
All right, time for a quick pop quiz. Just picture a chart in your head for a second. Price has just smashed through a previous high. Based on what we just talked about, where would your eyes immediately go to find that high probability order block?
If you focused on that final bit of selling pressure, that last down candle just before the explosive move up, you've absolutely nailed it. That specific area is our point of interest. So we mark that zone on our high time frame chart, and then we just wait. We patiently wait for the price to pull back to us.
So we have our directional bias check. We've identified our high probability zone, check. But here's the thing. We don't just buy blindly when price gets there. Nope. Now it's time for execution. We zoom into our lower time frame and we wait for the market to give us one final confirmation.
And this 4-step model is pure gold. So first, price comes into our zone and makes a little low. This tempts all the early, impatient buyers to jump in. Then, wham! Step 2, price sweeps below that low, stopping them all out and grabbing their liquidity. The real confirmation for us is step 3, when price aggressively shoots up and breaks the high that was formed before that sweep. That break creates what we call a breaker block, and that's our signal. We look to enter on the retest of that block.
Okay, theory is great and all, but let's see how this actually comes together on a real high-stakes trade. We're going to walk through a bearish setup on Bitcoin step by step using this exact blueprint.
Okay, so let's walk through this setup. First up, context. We're looking at the 2-day chart for Bitcoin, and it's pretty clear we're in a bearish trend. Now, what gets our attention is a fresh market structure break to the downside. That confirms our bearish bias. So what's our first step? We mark the high of the move and the new low. This is our new playing field, and right now we are only looking for chances to sell.
Next, we go hunting for our point of interest. Since we're bearish, we're on the lookout for a bearish order block. And what's that? It's just the last up candle before that massive sell-off. And look at that, we find one sitting perfectly in the premium or expensive half of our range. This is the most logical spot for big sellers to step back in. So our job now is simple. We wait for the price to come to us.
And now, for the final piece of the puzzle. As the price pushes into our 2-day zone, we zoom right into the 30-minute chart. Now look closely here on the chart. You see that high get taken out? That's the liquidity sweep, that's the trap. It's immediately followed by an aggressive break of structure to the downside. This powerful move down leaves behind these big imbalances, what we call fair value gaps. And those gaps, they're a massive clue that institutional money is behind this move. That's our green light to enter. And our target is that big external range low we marked out way back in step 1.
And that's pretty much the entire blueprint, from top-down analysis all the way to low time frame execution. But to make it even easier, let's distill all of this down into a final checklist that you can use before you even think about taking a trade.
Think of this as your final filter, your go/no-go gauge. Before you even think about hitting that button, you run through these 6 questions. And if you can't tick every single one of these boxes with a confident yes, then the trade just isn't a high probability setup. In that case, the best move you can make is to do nothing. Just sit on your hands and wait patiently for the next opportunity that does meet all the criteria.
And please, remember this. This is so important. The goal is not to win every single trade. It's to have a mathematical edge over the long haul. If your winning trades are at least twice as big as your losing trades, you don't need a crazy high win rate to be incredibly profitable. This is all about math, not magic.
And at the end of the day, that's really the final question, isn't it? The framework is simple, it's mechanical, it's repeatable, but turning this knowledge into actual results, that takes patience, it takes screen time, and most importantly, it takes the discipline to follow your plan, even when it's boring, even when it's hard. And that right there is what separates the pros from everybody else.